And that's all there is to it. So it's forcing them to lose money, forcing them to close, and they called it a holiday. All banks were closed until government examiners could investigate their financial condition. Thus, Roosevelt halted the rising tide of bank runs. A run occurs when depositors lose confidence in a bank, become panicky, and rush to withdraw their money. Let's pause for just a moment there. These bank runs, which were such a plague, there were 35,000 banks, I believe, in America. 15,000 or 20,000 of which went broke in the Depression. Huge numbers of banks. Now, Canada had 10 banks with thousands of branches. We had thousands of banks, and in some states, legally, they were restricted to one office. There was such a fear of the big banking trusts, big companies and big corporations. There was such a fear of them, reminiscent of what's going on today. They were terrified that big companies would get a whole bunch of power and then raise the price of bacon or something. So they wanted to prevent this. Banks were not allowed to open branches more than 10, 20, 50 offices, sometimes, like I said, no more than one office. Not only that, they weren't allowed to coalesce into larger structures. They weren't allowed to get together in groups. So some banks had 90 or 95% of their loans on their books were agricultural loans. It made them very susceptible to industry-specific problems, as Mr. Saltzman mentions. Now, that's different from a banking system which would try to acquire different loans in different areas, different sectors, try to decentralize itself, try to become diffuse so that any problem in a given area doesn't kill that structure, so that it's just a wound to the corporation or whatever. But instead they have it so that when there's a problem in this or that area, banks actually fail. And that was the source of that was government limitations on the banking. They weren't allowed to open very many offices. They weren't allowed to do this. They weren't allowed to do that. They couldn't get together in things. They couldn't do anything over state boundaries. They couldn't do this. They couldn't do the other. And then they blamed it on private enterprise. So, continuing. Only sound banks were permitted to reopen. And it makes you wonder, what did they mean? What do they mean by a sound bank? In the first of his many radio broadcasts, or fireside chats to the nation, the President assured the people that the reopened banks were backed by the resources of the federal government and were safe. This speech helped restore confidence and eased the banking crisis. If it eased the banking crisis, why was this followed by 7 more years of depression? So, to inflate the currency and bring about a rise in prices, you got that? They want prices to go up. Let's inflate the currency. That'd be good for everybody. It would create wealth, right? We would be richer, right, if prices were higher. Prices shouldn't be falling. They should be going up. Great. Brilliant, guys. To do this, the government abandoned the gold standard, forbade the hoarding of gold, and devalued the dollar. Abandoned the gold standard. True. Forbade the hoarding of gold. Not true. Forbade the hoarding of gold. Not true. They forbade the ownership of gold. Not the hoarding of gold. The ownership. They said you can't own gold. And they devalued the dollar. So if there's inflation, you're going to be more likely to want to spend your money before the value of your money goes down. Get something for it now. Get the economy rolling. That was their idea. So a one-time massive debasement of our currency. You had to come trade your gold in for dollars, and we're forbidden, not forbidden to hoard gold, you're forbidden to use it, to own it. The Federal Securities Act 1933 required companies offering new securities, stocks, and bonds for public sale to disclose all information relating to these issues. The Glass-Steagall Act 1933 prohibited banks from using depositors' money to trade in stocks and bonds. It also created the Federal Deposit Insurance Corporation, to protect depositors against the loss of their savings up to a certain amount in the event of a bank failure. We still all know the FDIC. Every time we walk into a bank, we see the FDIC sticker. The Glass-Steagall Act 1933 prohibited banks from using depositors' money to trade in stocks and bonds. That's probably still in effect. I don't know. Maybe it's not. But it seems to me that you ought to be able to deposit your money in a bank. And if the bank has a policy that what we do with the money you deposit is we invest it in stocks and bonds and we pay a very high interest rate, then you ought to be able to go put your money in there and get 7 or 9% interest when the rest of the people get 1 and 2% interest on the money in their checking account. You ought to be able to get 7 or 9% because they're using your money in the stock market. And at any given time they only have 20% maybe on hand. But I don't know if that's allowed now or not, but it ought to be. It sounds like an ingenious way for us to choose a bank that is performing well. You know, gives us more money. Skipping down a bit, the Securities and Exchange Commission was established in 1934 to supervise stock exchanges and protect investors against dishonest practices by stockbrokers and publicly owned corporations. This is insider trading speaks to this. The SEC is the one that looks into things of insider trading and puts people in jail because of it. Martha Stewart had a nicely decorated jail cell. And insider trading it's a travesty that that's prosecuted because the free market doesn't operate on the principle that everybody always has all information and you can't act until everyone has all information. That's not the free economy. The free economy says everyone has to do the best he can for himself. Now if you find out that this or that part of the company, this one company has no other medicines, it's a medical development company, it's got one medicine in the pipelines, nothing else coming through, and that's just been rejected by the FDA. In other words, the company's belly up bankrupt basically. Now thanks FDA. Who knows, maybe that drug had some value, maybe it didn't. That company sure thought so, and everyone invested in it thought so. And Martha Stewart sells because she finds out about this before other people in the market even know this, so they don't have a chance to sell, so someone else buys her investment. She gets out before it crashes. Insider trading, see. Now in the long run, trying to stop that type of little muddy water thing from happening is going to create way more problems than you're going to solve. All that happened there was people got confirmed the fact that investing in a small medical company which is subject to government whim is dangerous. That's all they learned. They bought Martha Stewart stock right before the company collapsed. They thought they were getting a good deal, but they got in on a highly regulated business subject to government whim, and they got burned. Now that's no more Martha Stewart's problem than theirs, and I should think if they were in the same situation they would do the same thing. That's insider trading though. That's prosecuted even though it shouldn't be. There are all kinds of scandals that you can come up with that could happen on the stock market, and were done throughout the 1800s. But the best way to get around those is for the people to develop trust with the companies they trade with. For the companies, one company has more transparency than another or whatever. One company has better public records available or whatever it is. And so this one is preferred over that one and gets more business and becomes the standard way and monopolizes, like Microsoft sells 97% of operating systems and this company takes 93% of stock trades or whatever because it's the one that's transparent and see-through and whatever. That's how that has to develop. You can't mandate it through government oversight. But anyways,